I think 10-year you will go close to or even below 1% within 2 to 5. The real interest rate is still too high. If you take the 10-year bond yield minus CPI, you're still talking about 1.8% real interest rate. And the 10 and the 20-year average of China of the real interest rate is only around 1%. So if the inflation situation doesn't change, you need the bond yield to come down to almost 1 percentage points to get the real interest rate more or less in line with the 20-year average. And mind you, the 20-year average real interest rate of China is much higher than that of the developed world, US, Europe, and Japan, which is like 0.5%. So I think in the past, China can tolerate higher real interest rate because the underlying growth trend is strong. Now the underlying trend growth is weaker. You probably need to keep the real interest rate even lower than the long-term average. In this sense, the 10-year bond yield has to go down more. I think with the new monetary policy changing from prudent to moderately relaxed, I think you probably will see interest rate coming down more. And I think China will, right now the bond yield has dropped below 2%. 10-year bond yield dropped below 2% in December last year. Based on experiences of other countries, if the economy responds well, then probably you will keep this sub 2% regime for 2 years. At least 1 year, but 2 to 3 years more normal. And if the economy not respond well, like Europe in the last decade because of European debt or Japan even worse, it could be very long. The sub 2% yield, Japan 10-year bond yield has been below 2% for almost 30 years. I don't think China will go like that bad probably, but look, we will be below 2% China 10-year bond yield for a long time. That long time, at least 1 year, more likely 3 years. That's I think if China can get out of the 2% bond yield, this kind of low range within 3 years, I think it's already quite a success.